It's certainly been the case that since the global financial crisis, which was called the global financial crisis but didn't really affect Asia at all, the Asian banks have been in better shape than their Western counterparts. And I certainly don't see that changing anytime soon. The one exception there is perhaps India, where with the slowdown in the economy, bad debts are rising, and that's going to probably cause some problems for some banks. But when we look across the rest of Asia, really the banking system's in great shape, and it's quite capable of taking up any slack if European banks or American banks decide not to lend in Asia. Well, I hope what happens is that we'll start focusing on fundamentals again, and that'll actually give people a much clearer idea of what's going on in emerging markets. India's going through a very rough patch at the moment, but you know, it's actually repairing itself. From our perspective, and we come at things very much from the Austrian school angle, recession, and we would really say that India's in recession at the moment. It's got a very, very low growth trajectory, much lower than its potential. That's the recovery phase as companies and businesses begin to shake out bad investments and effectively put their house in order, their balance sheets in order. So we're actually thinking that India is beginning to look quite interesting from an investment perspective. But it certainly wouldn't be helpful, I would say, if this largesse continues from the US, because that hasn't helped emerging markets. If you look at the underperformance of the equity indices over the course of the last 3 years in emerging markets, that's what QE has done. It's really clouded the picture rather than focusing on fundamentals. And I think once we start focusing on fundamentals again, emerging markets are actually going to look quite attractive. And if that focus comes probably second quarter of next year, India is going to look very attractive. You know, the interesting thing if we look at India is that the equity markets are bifurcated. The BSE 500, the Sensex is at almost all-time highs. There are very good companies in those indices, and that's probably why. But when you get into the mid-cap stocks and the small companies in India, they've been crushed over the last few years. So, you know, I think equity markets have correctly identified where the problems are. They're really not focused on, they're focused on the very large good companies, and so they should be. But I don't think it's really the prospect of equity markets and problems in equity markets that we should be focused on just now. It's corporate earnings and whether or not the corporate earnings are going to come through. I think interest rates are now a sideshow as regards the equity market. I suspect it's going to stabilise around here. I still think it's a bit oversold at 61.5. I think it really should be in the range 58 to 60 from a pure external balance perspective. But I suspect it's probably not going to get that much higher unless the RBI does the kind of things that we would hope they would do, which is to raise interest rates by 50 basis points. But at least I think that the currency has now stabilised. It's probably not the raging buy that it was at 67, 68, but I would still say that it's an attractive currency, and it will sort out the current account deficit over the course of the next year. By this time next year, we're fully expecting India to be running a current account surplus.